boa tarde a todos e bem-vindos a mais uma edição das Best Investment Sessions, uma iniciativa do Banco Best de promoção da literacia financeira e de reflexão sobre temas da atualidade. Estamos a aproximar a passos largos do final do ano, uma altura de balanços e de reflexão e de antevisão do que é que vamos ter em 2026. E é exatamente esse o objetivo da nossa sessão de hoje, refletirmos sobre os mercados financeiros em 2025 e antevermos o próximo ano. E para esse efeito temos dois convidados especiais, Sean Shapley, Chief Economist da Allianz Global Investors, e Carlos Andrade, economista-chefe do Grupo Novo Banco. Vou começar aqui pelo Sean. Hi Sean, welcome. Hi. And thank you for joining us on this session. We are closing to the end of 2025, okay? Time to reflect, to think about what happened during this year. What are the highlights that you can talk about regarding this year in terms of macroeconomics and in terms of markets this year?
Yeah, I think if we reflect back on 2025, it's definitely going to be seen as a year of two halves, to use a football analogy, and that the first half was really very disrupted, and we saw an awful lot of policy volatility coming out of the US, particularly around tariffs, which caused a lot of market disruption. So a big market setback in April, after which I think if we then transform our view back into the second half of the year, things started to stabilize. The economy showed a lot of resilience, much more than I think one would have expected given the scale of the tariff shock and the impact of the enthusiasm from the investor community for AI really started to kick in. And that became probably the defining theme of the year. From a European perspective, I would say what stands out is the German election results and the big fiscal package. So we went from a situation where expectations in Europe were really pretty depressed to one where there was more optimism. And from a growth perspective, what really stands out for the euro area has been the strong performance of what we used to think of as the peripheral economies. So from Spain and Italy in particular, they've been the strong spots and the positive credit stories, if you like, from a European perspective.
Mm-hmm. Carlos, you've been here last year, around this time of the year, doing the outlook to 2025. We had last year, one of the topics was the Trump election, the new term of Trump. Do you think that Trump getting to the scenes, politics scenes this year, 2025, brought us some surprises, or you imagine that this year could be something like it happened to be?
Well, in last year's outlook, our view for 2025 was based on the idea of moderate deceleration activity. You highlighted the idea of a slow disinflation, the possibility of a more persistent inflation than expected. We're about right in that respect. One of the main risks that we highlighted, of course, was the risk of trade wars and tariffs. And that was the case, but I agree that not really a surprise, but it was interesting to see how the global economy showed some resilience in the face of that massive shock, which was a very significant increase in tariffs. This trade and economic war between the US and China, which brought lots of uncertainty to markets, and strong pessimism, I agree with, in the first half of the year regarding Europe. And probably that I would highlight these two things. It was the way that the economy was able to adjust to these tariffs. You can say, well, tariffs didn't have the adverse impact that could be expected, but there was an anticipation of demand from companies and consumers to avoid the impact of tariffs, and this supported demand growth for a while. The implementation of tariffs was postponed in a way and then watered down So, and companies in the US also absorb a little part of, and in Europe and elsewhere, absorb part of the impact of tariffs. This is one thing. And the other thing is, in a way, the resilience that Europe showed. I think there are lots of concerns around Europe, but in any case, things, and this, when I look back at the different bullet points of our forecast, what probably we missed the most was we were more negative regarding Europe than
Okay.
looking at growth below 1%, probably be just above 1%, better than expected. And again, there are a number of things, headwinds that Europe is facing, but things were better than expected.
John, on your side, any surprises from 2025
No,
that you weren't expecting?
No, I think that Carlos made a good point. If I also had been thinking at the beginning of the year, what would the likely impact of the tariffs be for Europe, I would have expected a more negative effect. Frankly, the other surprise for me during the course of the year was the trade deal that Europe made with the US. I would have not have expected the Europeans to have been willing to sign up for 15% tariffs without any retaliatory measures. So that was a significant surprise.
Yeah, I agree with this point. It's interesting because if we're facing this increase in tariffs from the US, it was a surprise for me that most of the countries did not retaliate in a very significant way. So this was not expected, probably.
Understand that Trump strategy was somewhat a success in that sense.
Yes, I mean, I think if you split the world into two, so China on the one hand and everyone else, Trump pretty much got his way with everyone else.
Except China.
Where he didn't get his way was with China. And it's clear the Chinese were very effective in leveraging access to rare earths as a political tool to prevent the trade position with the US from deteriorating further. They controlled that situation very effectively, I would say.
Basically, they have better weapons to deal with the Trump and the US
Europe,
power
clearly,
than Europe.
Although I would say that the impact of tariffs in the US economy has been mostly negative, and it's not fully visible, but you can see the impact in the prices of some goods. You can see in consumption, particularly medium, low income consumers are struggling with this theme of affordability, which has become even an important political theme in the US again. It was visible in these last midterm elections. Firms, and I was just reading today the examples of some firms that have the need to increase indebtedness just to pay tariffs. So there is a cost of tariffs. So it should not be dismissed as
Okay. But I believe that Trump's strategy, more a long-term strategy, trying to regain industrialization inside of US, probably.
Yeah, that's definitely true. I mean, I think that their view is of the need for an acceleration in investment, which I think is very likely to be delivered in the US, already starting and continuing into 2026, and some reduction in consumption. Now, at the moment, as Carlos said, that there's a real bifurcation between the wealthy consumers in the US for whom life is great, and those who have exposure to the equity market in the US feel great about everything that's going on, and the sort of bottom half who don't really perceive that they're doing well, who are concerned about the cost of living, and for whom things are tough.
Okay. In terms of markets, 2025, well, we are not in the end yet. We still have about roughly a month, but we may say, at least for the equity side, that it has been a good market year. Okay. Basically, it seems to be almost every equity market index seem to be positive this year. Okay. Okay.
Although I would highlight the fact that you had some instances, for example, where we had some tech companies reaching its highs, and you had 60 or 80% of an index falling in that session. So it has been
The index does not
a little bit
reflect the whole
concentrated
market.
in a way, yeah.
Yeah.
Okay.
So, like the economy also.
Yeah, I think it's been very true actually. This sort of dispersion that you have had between, well, we've talked about it in the macro economy for the consumer in the US, and the same is true very much in the equity market. And to some extent, it's starting to see signs of it in the credit markets as well, that there is this dispersion between those who've done well and those who've not done so well. And even though growth has held up well, what Carlos was talking a little about earlier on in terms of the tariff effect, it has left a mark.
Okay. Now moving to 2026. Okay, next year. Okay, what are you expecting in terms of economic growth for the major regions? What regions may be ahead in terms of economic growth, and those who may be lagging from the rest of the world?
So I think our expectations for growth for next year are for something that for the US and Euro area looks similar to trend, but I think the difference with this year is going to be the trajectory, in that it looks like the US economy is going to slow down a little bit in the fourth quarter, and then we're expecting an acceleration through the course of next year. And similarly for Europe, actually, we think the Euro area economy also will tend to pick up pace during the course of 2026. Away from the US and Europe, China looks as though it's going to need some more stimulus to meet the government's targets of 4.5–5% growth, which is where we expect that they're going to try and target things. And then the country of the majors that really looks as though it's different is Japan. So Japan's on a trajectory now where it's got very loose monetary policy, has just loosened fiscal policy some more, so they're trying to accelerate growth from a standpoint where growth's not so great, but inflation's already above target. So that's an interesting story for next year.
Okay, and what do you think are the main drivers for that growth? US, in Europe, and the rest of the world?
Yeah, so I think the key drivers for the US are going to be the AI build-out. So we're sort of into the phase now where the leading companies are planning for success and are boosting their capital expenditures very materially. And to facilitate that, it requires an expansion of data centers, an expansion of the electricity grid in the US. So there's going to be a big industrial focus for re-expanding activity in the US economy. I think that's the single biggest factor. From Europe, we've obviously got the build out in Germany, so infrastructure focus, defense to some extent also for the European economy as areas where there are going to be expansions for next year.
Carlos, do you want to get into more detail, for example, inside of Europe? And if you want to add something about Portugal?
But even in the US, I agree that the theme of the AI investment is set to continue for next year for sure, even with all the doubts that we may have about bubbles or not bubbles. But this is almost unavoidable that this very strong growth in investment will continue next year. I think the topic you mentioned about the need to build capacity to generate electricity will be very, very important, I think. And right now, China is way ahead of the US and Europe on that respect, which is an advantage. But also, besides that, also the US is benefiting from, and will benefit, I think, from more supportive financial conditions. Actually, we have these equity gains, which Sean mentioned, has been supporting those consumers, those households that are more exposed to equity markets. We have interest rates coming, the policy rates coming down, so we'll talk about that probably. Even we have, not so relevant probably, but a weaker dollar, it's also contributes to this more expansionary financial conditions, and we will have the big beautiful bill coming to effect through lower taxes, and this should also be helpful for firms and households. And turning to Europe, it's interesting, and you mentioned Portugal, and Sean mentioned Spain and Italy. I think that's one interesting thing that, of course, Europe and the euro area is facing also these headwinds coming from the US tariffs. I think the one thing that's important is this increased competition from China, which is disinflationary, and it's probably hurting also European firms in the industrial sector. But what we have is growth being supported by countries like Spain and well, Portugal is small, but the story is the same, that are not so exposed, not so reliant on manufacturing sector, not so exposed to the impacts of US tariffs, and rely more on services and on, for example, tourism, which has been booming in the periphery. But these are also economies, and you could include Greece, for example, also, and Italy, of course, that in a way, but are also benefiting from more favorable perception from investors from outside, which translates into more favorable financing conditions. Portugal, you asked me to talk about Portugal, has been showing a twin surplus, so surpluses in external accounts and in public accounts, and this is important, and it has translated, for example, in upgrades in sovereign ratings, for example, and this translates into better financing conditions, low unemployment rates. Okay, that's important also, and the fact that public accounts are in better shape has allowed also for some fiscal stimulus, supporting income and consumption. So, looking ahead, I think this will be supportive for growth in the euro area, and we will have the lagged impact of lower interest rates. We'll have more expansionary fiscal policies. You mentioned Germany, of course, but even in these other economies, we'll have the implementation, the final year of the implementation of the next generation EU plans. This will also be supporting investment. So this is a driver of growth also.
Yeah.
So we do expect growth, and I agree to remain around trend. So it's still slow growth, low growth in Europe, slightly above 1%, but it's probably around trend.
Okay, you talked about moderate growth. Low unemployment, spendings from governments, this usually tends to go to inflation. Okay, what impact will this have in inflation?
Yeah, and I think so. Let me make 2 points about that. I just want to touch on something that Carlos said about the improved fiscal position that there is in Portugal, Spain, and Italy, because I think it's a real differentiator. When you think about the broader environment, you're looking at a situation where budget deficits in many countries are rising rather than falling, and in the US they're still above 6%. So it's indicative of these very long cycles that you have in fiscal policy, where countries like France and the UK are having real difficulty in bringing budget deficits under control. So where you've got a situation in Italy, Spain and Portugal where they're on the other side of that and into the benign phase where you're getting the growth benefits of controlling the budget deficit, that's a real credit positive story that I see coming. So bring it back to inflation. I think starting with Europe, which is the easier story to tell, Europe similarly is a benign story for inflation. We saw just this last week that the negotiated wages series that the ECB puts together has now fallen below 2%. And although that probably exaggerates the scale of the improvement, nonetheless, wages look to be at a level that's very consistent with the inflation target. So our expectation is inflation in the euro area is going to be below 2 for much of the course of 2026. And if there is an agreement over Ukraine that allows Russian oil and gas exports to restart, then energy prices are going to be coming down. and that could deliver actually a new source of stimulus into the European economy and be an upside surprise potential for growth for next year.
Energy prices has been a pain
It's
for
been
German economy.
Exactly right. It's been a real source of stress for a very long period of time. And so changing that would be a material shift in the environment, actually. From a US perspective, the story on inflation is not so clean. And we're going to start the year with inflation comfortably above target. It's likely to remain there for the first 3 to 6 months of the year because the effects from tariffs that Carlos was talking about are still going to persist in the system. So we're not expecting that issue to disappear overnight. But underlying the tariff impact, it does look as though inflation is a bit more benign in the US as well, and is showing some signs of decelerating. So I don't think inflation is going to be a determining factor that stops the Fed from bringing interest rates back to at least neutral, let's say.
Okay, that was my next topic precisely. After inflation, monetary policy, okay, both from Fed and the ECB, what can we expect from next year, Carlos?
Well, I do expect the Fed to bring policy rates down a little bit further. Regarding the ECB, I have some doubts. Our base case is that probably rates will remain on hold because if you are anticipating trend growth and inflation converging to your goal,
to the target,
there's no reason for you to change things. But I do believe that there are risks that could bring inflation further down in the euro area. Sean mentioned the energy side. Have a stronger euro. You have something that I mentioned, which is this impact from increased competition from China, which is disinflationary. The shock from tariffs is also a negative shock on demand. So, and you have, at least in some economies, you don't have the room to stimulate that much. So there are some elements that could bring inflation to lower levels than what are expected right now. So I see rates on hold in the euro area, but risks that the ECB could cut a little bit further.
Cut rates. Okay.
And in the US, you do have it's more difficult to talk about that. You do have these signs of persistence in inflation. I think that there's still some room for the effects from tariffs to become more visible in prices. If you look at core goods prices, it has come from slightly negative or zero inflation already to 1.5% inflation, which is still low, but it has increased a lot in just a few months. So this could still be an issue next year. You have also some probability of shortages in the labor market also that could be some brings here some element of pressure through wage growth. We'll see about that. But I agree that the Fed will give priority to these signs that the labor market may be weakening. It is true that has been this low hire but low fire economy. So there's not much hiring going on, but firms don't appear to be increasing significantly the layoffs, although there are some signs that this could be becoming more visible. And I think the Fed will respond to those risks. And I agree that most probably, rates right now in the US are slightly restrictive, so there is room to bring them down at least to a more neutral level. In the euro area and the ECB, I think that even if there are reasons to cut, the resistance within the governing council will probably be stronger, but in the US, it will probably be easier to bring rates down. And even because next year we'll have changes in the composition of Monetary Policy Committee, and this may be facilitating also some cuts. between 2 to 4 cuts, I think we could be expected, at least bringing rates down to 3.25%.
Okay, Sean, do you have a similar view?
Pretty similar. I mean, I think that for the ECB, our expectation is one more cut. And it's a similar sort of set of thinking to Carlos's in a way, in that it's clear the ECB is pretty comfortable with where it's at. But also it's pretty clear that they're forecasting below target inflation. And in that environment, if you then see this move lower in headline inflation that we're expecting, and you've got below target headline inflation, you've got below target forecast inflation, you're an inflation targeting central bank, you're supposed to cut rates. So that's our expectation. What I would say is that the ECB is in a position where if growth falters at all, the central bank put's going to be operative. They have the capacity to cut interest rates if they need to, very clearly. So that's good. I think Carlos's points on the Fed are also right. You know, the independence of the Fed and the degree of politicization of monetary policy in the US is a theme for next year, very clearly. And we don't know yet who President Trump is going to put forward as the new chair. Chances are it's going to be someone who favors lower interest rates. And so that's behind part of our forecast for another 50 basis points off US rates. Beyond that is also possible if this impact of AI in making companies less willing to hire, particularly for younger workers, if we see that extending very much further, you can see that the labour market in the US is pretty close to a break even now, where jobs growth of 0 to sort of 50,000 is the zone where it seems to be that's enough to stabilise things. And it's a bit like when you have interest rates close to the zero bound, it doesn't leave the central bank a lot of wiggle room if things start to go weaker. So I think that means that the Fed, a defensive strategy from the Fed is to get rates that bit lower and make sure, have greater confidence over the cyclical strength in the economy.
Okay. Lowering rates is something that Trump has advocated since basically he's on he's president from the US. You both talk about Fed, the new council. Do you think there is an issue of further independence of the Fed in the future, or is something that we should be not concerning, or we should not be concerned?
I think we should be concerned, but I think the market will be concerned if that happens, and I think the market will be saying something about that, and so I think if things go in that direction, it will not be peaceful. So yeah, markets will have a way to have a say on that. Yeah.
Yeah, and I definitely think that's right. I think in central bank policy, individuals matter. The person at the top has a very high degree of influence on the character of the institution and how they pursue policy, and it makes a big difference. So, I would say that all the most likely candidates for the new Fed chair are respected individuals. It's not as though Trump is going to pull someone completely from left field, or at least that looks unlikely. However, there is definitely also a spectrum within the candidates of how the market's going to react to them and the ways in which they may seek to engage with the rest of the US administration that can have significant effects on the structure of the Fed and how it seeks to support the broader US administration's policy. So yeah, it's a big topic.
Okay. Now, passing from the interest rates from ECB and Fed to bond markets, what are your perspectives for bond markets next year, seeming that you both agree in some degree about lowering interest rates both in the US and on Europe?
Yeah, so I think I would say it's an environment where bond coupons are going to be a significant contributor into investment portfolios. So I think having some exposure to bonds definitely makes sense within the context of a broader investment portfolio. I would say that the scope for significant capital gains looks relatively limited, given this backdrop of an economy that looks okay, has got through a big shock, where monetary policies closer to the end of the easing cycle than the beginning, and therefore it's probably a year where your expectation is you're going to earn your coupon from holding bonds, and if anything goes wrong in the equity market, you get the insurance of the potential for more gains if the central bank responds to that with lower rates.
Carlos, we are talking about growth, moderate in Europe, slightly more in US, interest rates going lower. Do you see risks from the credit side, default risks from the credit side, or is something?
I do see some risks there. We have been seeing some news about some problems with some companies, and this is in every case somewhat associated with what's going on in private credit, and these have been dismissed in some ways as these are idiosyncratic, very specific situations and so on. But in my view, they tell probably a more consistent story. You can see what happened. It was related to lending lending to autos, for example, and subprime lending to autos, lending to commercial real estate, and over-leveraged companies, and some lack of transparency also. So I don't see this exactly necessarily as very isolated. They could be a symptom of something. So this is one of the risks that we see, okay? That more cockroaches come, as Jamie Dimon was saying. If you see one, there may be more. So this is, but we see this as a risk, okay?
A potential risk.
And this is actually one thing that we see is that if you look at the implications of this environment, macro environment that we've been talking about, if you have growth that remains supported, even if it could be slightly slow growth, but growth still, the economy expanding, you're expecting lower rates probably. This is good for you have lower taxes in the this is good for growth, it's good for earnings, so probably good for equities also, and for also for the credit market, you can say that. But this will happen, in our view, in more shakier grounds, okay? We're heading towards an environment of weaker regulation, for example. You have these discussions about possible bubble in these investments related to AI and in equity valuations. You have these concerns about the credit markets. So in my view also, this is a completely different theme. We are witnessing this rise of and more policy support to the rise of stablecoins, for example, and the regulation about this is also not sure about that. So it's a fairly positive outlook in terms of growth, but in our view, you have to be careful because the ground below is not so solid. So this is a risk that we see. Yeah.
Okay. Sean, do you agree?
Yeah, I think it's definitely an environment for active management of credit portfolios, that this dispersion and the build out of AI is just going to be a source of capital demand, and the market has to find a new balance to accommodate that increased demand for capital. So that's sort of how it works out. What I would say though is, and we saw this in the aftermath of the inflation shock and the recovery that we had in 23-24, that high yield portfolios can actually cushion you against an environment where nominal growth is strong. And so you don't necessarily want the duration in the portfolio, but the uplift to growth and the pricing power that firms have in that environment can be actually nicely captured in high yield portfolios. So yeah, I think expectations are that it's going to require, as I said, some active management of those portfolios, but I wouldn't throw them out and just say there's no value to them. I think there is some value.
Okay. We've been talking about interest rates. Interest rates are one of the determinants about exchange rates. Dollar is having a weak year. It's devalorization against euro, at least. It had some recovery on the last weeks. What do you think that will be the way for dollar for next year, Sean?
So I think the view on the dollar is that the medium-term trajectory is still down. And there's a mix of reasons for that. First is that it's part of the US administration's policy. So they have a strong desire to see the dollar cheapen as part of their reindustrialization strategy. So that's part of the motivation for the view. Secondly, we've talked a little bit about change in the Fed chair and what that signals for monetary policy. That also contributes. And then I think, importantly, the thing that we saw change in 2025 that will have a longer effect is that investors used to love having exposure to US assets on an unhedged basis, because when equities went down, generally the dollar went up. Mm-hmm. And so you got that cushioning effect. The portfolio balance was provided by having the unhedged exposure to US assets. And this year that didn't work, or it worked much less well. And so I think that's caused a rethink from lots of investors about how much exposure they really need to have to the dollar. I think hedging ratios have risen as a result of that, and that it will require a very significant change in the dollar's performance to encourage people to take those hedge ratios back down again. So I sort of think that's a sustained change in the environment that we're going to live with for the next at least 12 to 24 months.
Okay. Carlos, on your view, similar?
And it's, as an economist, on one side this, on one side that. But we did see the dollar coming down also because of this perception of unpredictability coming from US economic policy. On one side, you had that concerns about US public debt and deficits, for example. Low rates, I agree also. But another element which I think it's important is probably some diversification of external reserves on the part of other economies, and including China and others. And this comes from different reasons, even from political or geopolitical reasons. But on one side, you may have the US freezing assets, Russian assets, for example. If you are another country that may or may not be in good terms in the US, you don't want to risk that, so it's good to diversify also away from the dollar. And so I think there will be eventually some challenge. The dollar will be challenged in its role, but I think it will not lose that role as a main currency in global financial movements and trade flows. We are away from that, but there is some challenge on that and some diversification of reserves that also help explain that in my view. But on the other side, well, it's still the US, still the economy where you have NVIDIA, OpenAI, and Microsoft, and so on, and it's a very strong and liquid markets that you have there, very dynamic companies that you still have there. It's still dominant currency in payment systems, so it's very difficult to challenge that. And the US has a big current account deficit, so it sends dollars to other economies, and that's, I think, a necessary condition for a currency to be a main currency in payments and in trade flows and so on. Mm-hmm. And this is a very unique situation that the US has right now. I think, again, it will be challenged. I think China is doing something in that direction, but we are far away from that. So between all this and the fact that, again, I think 2026, the AI theme will still be very strong theme, very attractive for investments. If we ponder this, I think that dollar will have some factors that it's pulling it down, others pulling it up. I think we will end up more or less the same.
Okay. Before going to AI, you talk about reserves. Basically, gold had made the opposite path of dollar this year. Okay, it rised a lot, and do you think
in my view, it's part of the same story? The
Yeah,
diversification of reserves.
of reserves? You think
Of
that
course,
it's the same story?
you have also it was a very in the first part of the year, and it was a very uncertain year, which also favored gold. But it's part of the story of reserve diversification.
Being a safe haven on one side, and on the other side,
Exactly,
an
yeah.
increase on reserves from central banks.
Yep, no, very much so. And I think to support Carlos's argument, I think actually it was a conclusion that was reached by many central banks, particularly in Asia perhaps, during Trump's first presidency. They simply had to reduce their dependence on the US, and that the US was not a reliable partner, and they needed to make structural changes to achieve that. And part of that was reduced demand for treasuries in their portfolios and increased demand for gold. And gold, as it has pretty price inelastic supply, when demand goes up, the price goes up, materially, as we have seen. And there's no reason to really think that, from a structural base at least, that the people who've just bought it are going to go and sell it very quickly. They're holding it. They're in there for the longer term. If we take this secular theme as being one that will persist. So yeah, with the desire to have some sort of exposure to something that will hedge you in the event that the US does run a more inflationary monetary policy, and with other countries, frankly, including Japan, running much more inflationary monetary policies at the moment, it's not just China that's looking for that sort of a hedge. So yeah, I think the backdrop for gold remains a constructive one.
Can we take from that there is still space for gold prices to rise?
I think so. Yeah. I mean, you're at levels that require an intake of breath to reach that conclusion. But yes, I think so. Yep.
I agree with that. Yeah.
You agree that it's still okay?
But again, starting from a very higher base, you cannot expect the same thing to happen.
The same rise.
But the fundamental factors that supported gold are still there.
They are remaining. Yeah. Okay. Carlos, you talked about AI. Okay. There is a significant growth in stock prices from AI companies. Are we in the presence of a bubble? Or there is still space for growth on these companies? Are we beginning a new secular trend with AI, or this is like a bubble that may burst around the corner?
I think both probably. We are probably in a bubble, but there's still room to grow also. And it's interesting. We know that there are plans that we know, very specific plans that for new investments. So we talked about this 2026. There will be again massive investments in AI infrastructure and so on. Data centers, equipment, software, capacity to generate electricity and so on. These will be very, very important and will happen. But we are in a phase, and if you look in, I'm sorry to go to go back in history, but if you look at other moments in history where you had these new disruptive technologies coming, railway mania in 1860s, and .com in the transition of this in late 1990s, early 2000s, you have lots and lots of investment, and you don't have, in any case, investments. They're not all rational. You go with the flow. There's some fear of missing out. There's some exuberance, but these are, you can call it productive bubbles, in the sense that most probably there are investments that will go wrong, but at the end of the day, the technology, which will be a very valuable technology that will change the world for sure, will remain, like the trains remain and the internet remained. and they were transformative, and there will be winners of that process. So there will be companies that will remain. My view is that in the process, we'll have some significant corrections and some companies will fail. My concern here is that we are seeing an increase in indebtedness related to these investments, in some cases with more complex structures, some financing that has a circular nature, which is also a potential problem. So yes, I would say there's definitely some risks there. I would say that eventually we have some corrections, but at the end of the day, technology will remain, and it will be an important one.
Mm-hmm. Yeah. Sean, on your view?
Yeah, I think actually I share a lot of Carlos's observations in terms of where we're at in the process, mm-hmm. and how things are likely to work out. What I would say is that up until now, the market's been very happy to run with the theme, mm-hmm. because the leading companies who've been making the large investments have been the ones who are generating the revenues as well. And so they've been in a position where, great, you're making those investments and you're making tons of money, so there's no issue, right? I mean, in fact, it's all about how quickly you can do it, and the revenue expectations just sort of ramp up, and that's the cleanest phase in many ways. Now we're into the phase where actually the need for capex starts to become more influential, even for some of the leaders and for some of the other companies who have already a bit more leverage. Then the need to try to generate results very quickly, and that desire for more capital to accelerate the capex, and then you can see the credit market starting to say, well, maybe. So it's a material change from where we were at in the first 8 months of this year. And not all the players have easy access to finance, and that generates this desire for mutual support in a way. Mm-hmm. And at one level, that's okay, because collectively they definitely have the resources to do it. At another level, it sort of generates this internal leverage that then when you're trying to hedge, you find that the overall cost of credit for some of the companies involved starts to go up and becomes a binding constraint. So I think for 26, what we may find is that the broad trend remains, but this tension between, on the one hand, wanting to go really quickly so you get the revenues in, mm-hmm. and on the other hand, the credit costs of doing that becomes more of a source of conflict in the different parts of the market. And so that's one innovation. But I think from a longer term perspective, our own view is that we're still very early in the innings, and there's a long way further to go, that companies that are going to benefit from the absorption of AI are still a long way back in the queue. And so there's both they've got a lot to do, but also the potential gains from that are very substantial and not really being factored in at this point.
Okay, basically we are seeing the winners of AI being the companies that are producing, or the chips, or the companies that are producing AI engines, but on this stage, the current stage, but further in the future, we may see these gainings getting to the earnings of other companies that will use AI on their normal day-to-day business.
Yeah, I think at the moment you just have this remarkable, highly oligopolistic competition where the leading handful of companies are trying to accelerate things really, really quickly because they want to dominate. Mm-hmm. And in the future, that can't be the model, because someone else has to want to use it to pay them to generate it. And that's the break that we have to make. And maybe it's not in 26, but it's sort of coming into the horizon.
Mm-hmm. Do you share the view of Carlos that there are some risks, meaning that some of these companies that are right now on the top of the wave in terms of AI may not survive in the future?
Just to add something, and people and companies who invest in the team also.
Mm-hmm.
Yeah, I mean, definitely, there clearly are valuation risks, and Already we're starting to see that, from that leading group, you're getting a desire to source chips more cheaply from other companies. And so, there's going to be a tension between that we'll see, and the overall market valuation is clearly elevated. So there are definitely ways in which it can go wrong, but our view at this point is that there are more ways in which it can go right. And that's sort of still an important theme alongside it's not that we're saying everything for next year is driven by this, but you're in an environment where you've withstood a major shock, you've got easier monetary policy, and the scope for rates to continue to go down if necessary, then it's still an environment where I think equity risk is attractive to take.
Okay, we are getting close to the end of our session. If you could identify the opportunities for 2025 for investors, what will be the main sectors or asset classes that you think that will have that can have an impact, a positive impact in terms of investment for our clients?
But I suspect that a key decision that investors are going to have to make is how quickly this broadening out of the gains that the leading tech companies have made into the broader economy. How quickly can that actually happen? Because at the moment leadership is very concentrated, and historically we know that doesn't tend to remain the case for long periods of time. But at this point, the broader equity market looks well set. We think scope for some of the lagging sectors that have not performed to start to benefit more as we go through into 2026, not least because of the cyclical upswings that we anticipate in the Europe as well.
Okay. Carlos talked about, for example, about the energy sector from electricity production.
Yeah, for sure. In the US, that will be a main theme. It will have necessarily to be, there will be the need for massive investment there also. So there are many opportunities there to have good returns on investments there. Yeah.
On investment on that side as well. And we talked about gold having at least some margin to keep growing in the future. Okay.
Yep.
Carlos,
I'd highlight only the idea of diversifying also away from these themes.
Yeah, sure.
And you do have, I know it's very difficult and it's probably wrong to talk about emerging economies as a whole, as a homogeneous group, but you do have this interesting story that you had more from a macro perspective in terms of debt levels, public finance management, and so on, more balanced situations there, and so there's more also room for economic policy to maneuver, and so there is, I think, and also China with its goal of being more influential in other economies. There's also some gain for other emerging economies that comes from there. So there's also, I think, an opportunity there. I just mentioned one statistic that I was seeing. If you look at rare earth reserves, China dominates completely. But then you have in the top 5 countries like Brazil and India, for example. Okay. And Brazil is not even producing anything significant yet, but there are some elements of potential in this.
When we were saying emerging markets, you were talking more about Latin America, Asia, also, or both? Yeah. Okay. And your view on emerging markets?
Similarly constructive, actually, for the broader asset class. And I think Carlos has touched on a lot of the themes. The desire for the industrialization strategy embeds a need for energy and metals. And up until now, we've seen the US have a strong interest in keeping energy prices low because of the midterm elections, and that's not going to go away in the next 6 months. After that, different game. And so we may well start to see a more general uplift in commodity prices as we go through late in 2026 into 2027. I think that's a potential theme. And EM normally does very well in those types of environment.
Yeah.
So that generally is a theme. And I also think that this conflict between China and the US means that China has a very strong incentive to continue to develop not only its industrial sector, which is done very effectively, but also the tech sector. And so I think thinking about your scope to differentiate or diversify across those different regional blocks is an important part of forming an investment portfolio too.
And talking about risks that we may anticipate for 2026, Carlos, on your view, what are the main risks?
Main risk for all these stories that have, if you have more persistent inflation, and if the market has overestimated the extent of policy rate cuts in the US, for example, that would be a main risk for a number of reasons. We saw this week, for example, that markets were showing this concern about the overvaluation of inequities related to AI, and but then you had some people from the Fed saying, no, we are open to more rate cuts this year, and the market responded very quickly. So I think there are two concerns in the market, which is this related to the possibility of this bubble in AI investment and overvaluation in equities, the possibility of corrections. And the other main concern is a more hawkish Fed. So if you have a more hawkish Fed, there are a number of these elements from our more supportive and benign story that are not valid anymore. So I would say this is one of the main risks that we see. And if you have the AI story, for example, in the sense that it has been supporting investment in infrastructure and so on, but also it has created this wealth effect that has helped private consumption in the US, although not for everybody, but it has supported consumption. And so if you have a correction there, those investments are not so attractive anymore, then you have a number of things that come unravel.
Yeah, Sean, on your side, risks that you want to highlight.
I think we've touched on them well actually during the conversation. So more risk of speed bumps is probably a way to think about it, both in terms of valuation, inflation, which Carlos has touched on well, and then the risk that the re-acceleration of the economy and the need for more capex and more capital finance that generates more tension in the market. So those are, I think, probably the three things to reflect on.
If I may highlight just one positive risk, for example. No,
positive risk. Okay.
But if you can have all this translating into stronger productivity growth, for example, which allows stronger growth without this inflation pressure, that would be a positive risk. Okay, so you'd have stronger growth with moderate inflation, possibility of lower rates. That would be a positive risk.
A very benign scenario.
The end of the war in Ukraine could be a positive risk also. For Europe, a recession in the US would be an obvious negative risk, of course.
Recession in the US, it's one of the things that usually we tend to talk on this time of the year is black swans for the next year. That could be one of them that...
I wouldn't call it a black swan, but it would have
a major impact.
It's something that we think about, that we may anticipate. Yeah, but it's a risk that we see.
The US is very two-tone. At one level, I find it curious that there's talk about recession at a time where the tech sector is booming, and we've got the build out of the capex. But it is true that the labour market is softish, and so that leaves that uncertainty still there.
Ok, thank you. Penso que já terminamos. Espero que esta sessão tenha sido útil para antecipar o ano 2026, para identificarem oportunidades de investimento e identificarem os principais riscos que podemos contar para o próximo ano. Mais uma vez, obrigado por terem assistido a esta Best Investment Session. Se qualquer questão que tenham, temos sempre a disponibilidade de poderem enviar um e-mail para rp@bancobest.pt. e até uma próxima Best Investment Session.